Hello and welcome to Calling Monster Finance. It's September 17, 2025. Today, the U.S. markets delivered a complex and divided verdict following a highly anticipated policy shift from the Federal Reserve. The central bank cut interest rates for the first time this year, a move designed to support a cooling economy. However, instead of sparking a broad rally, the decision exposed a deep rift in investor sentiment. The session ended in a state of clear divergence, with blue-chip stocks advancing while the technology sector retreated. This paradoxical reaction was driven by mounting concerns over a stagflation-lite environment, the simultaneous threat of persistent inflation and a weakening labor market. Ahead, we'll break down the Federal Reserve's decision, analyze the critical reaction in the bond market, and examine the structural rotation playing out across different market sectors. The main story on Wall Street today was one of dovish dissatisfaction. The Federal Reserve delivered the 25 basis point rate cut that many had expected, yet the market's reaction was far from celebratory. The initial relief rally quickly faded as investors digested the central bank's cautious outlook and the challenging economic picture it painted. This led to a significant split in performance among the major indices. The Dow Jones Industrial Average, which is heavily weighted with value-oriented and financial companies, closed in positive territory, gaining 260.42 points for a 0.57% advance. In stark contrast, the tech-heavy Nasdaq composite fell 72.63 points, or 0.33%. The broader S&P 500 was caught in the middle, ending the day nearly flat with a minor loss of 6.41 points, or 0.10%. This divergence reveals a sophisticated repricing of risk by investors. The market is no longer operating under the bad news is good news paradigm, where signs of economic weakness are welcomed as a catalyst for monetary easing. Instead, today's trading showed that concerns about underlying economic fragility are now taking precedence. The most telling signal came from the bond market. In a highly unusual response to a rate cut, long-term Treasury yields actually rose. This suggests that bond investors are pricing in higher inflation for longer, questioning the Fed's ability to navigate the narrow path between supporting employment and controlling prices. Ultimately, the day was a cautionary recalibration, as the market confronted the reality of a central bank facing a difficult policy trade-off. The primary driver of today's market action was, without question, the Federal Open Market Committee's policy decision. The committee initiated its easing cycle with a quarter-point rate cut, citing that downside risks to employment have risen. This formally signals a pivot in the Fed's focus from an exclusive war on inflation to a dual mandate that now gives significant weight to a stalling labor market. However, the details surrounding the decision revealed a lack of firm conviction. The vote was not unanimous, with one governor dissenting in favor of a more aggressive 50 basis point cut. Furthermore, the Fed's updated summary of economic projections painted a challenging picture, forecasting 2 more cuts by year-end, but pairing that with stubbornly high inflation forecasts around 3.0% and a rising unemployment projection of 4.5%. This data quantifies the stagflation-lite scenario that has investors concerned. The subsequent press conference with Chairman Jerome Powell did little to soothe market nerves. He framed the cut as a risk management adjustment, rather than the beginning of a sustained easing cycle. His non-committal tone and emphasis on data dependency left the market feeling that the Fed's future path is highly uncertain. This uncertainty was reflected most clearly in the U.S. Treasury market. The benchmark 10-year Treasury yield, which typically falls on expectations of easier monetary policy, instead climbed 5 basis points to close at 4.08%. This phenomenon, known as a bearish steepening, is a classic signal that the bond market believes the central bank may be making a policy error by being too slow to address future inflation. The rise in long-term rates directly tightens financial conditions, working against the Fed's intended stimulus and placing immediate valuation pressure on growth-oriented stocks. The Federal Reserve's decision did not occur in a vacuum. It was set against a backdrop of significant political pressure from the executive branch. President Donald Trump and his administration had been publicly calling for a big rate cut for weeks. On the day of the decision, Senior counselor Peter Navarro explicitly stated that the Fed should cut rates by 50 basis points. This context was critical to how the market interpreted the 11-to-1 vote, which featured a dissent from Governor Stephen Moran, who advocated for that exact 50 basis point cut. Market participants viewed this dissent not just as a technical disagreement on policy, but as a potential sign of political influence within the committee. This perception added a layer of unpredictability to future Fed actions and contributed to the risk premium demanded by bond investors, as evidenced by the 10-year Treasury yield rising to 4.08%. Meanwhile, in the corporate sphere, Tesla served as a notable case study. The company's stock entered the session with strong positive momentum, following CEO Elon Musk's recent open market purchase of nearly $1 billion in stock. On a day when rising long-term interest rates created a significant headwind for high-valuation technology stocks, Tesla bucked the trend. While the broader Nasdaq composite fell 0.33%, Tesla shares closed higher, gaining 1.01% to finish at $425.86. This resilience demonstrates how powerful stock-specific narratives can sometimes override broader macroeconomic pressures, at least in the short term. Looking beneath the surface of the major indices reveals a clear rotational story playing out across the market. Today's divergence was not random. It was a structured shift away from rate-sensitive growth sectors and into more value-oriented areas of the economy. The primary laggard was the information technology sector, which fell 0.70%. These companies, whose valuations are heavily dependent on future earnings, are particularly sensitive to rises in long-term interest rates, which increase the discount rate applied to those earnings. Similarly, the consumer discretionary sector declined 0.31%, reflecting concerns about a weakening consumer in a slowing economy. On the other side of the ledger, the financial sector was a standout performer, gaining 0.96%. Banks and other financial institutions can benefit from a steeper yield curve, where long-term rates are higher than short-term rates. The consumer staples sector also performed well, rising 0.90%. This is a classic defensive move, as investors seek out companies that provide essential goods and services, which tend to have more stable demand regardless of the economic cycle. This clear split, with defensive and value sectors outperforming growth and cyclical sectors, confirms the market's cautious interpretation of the Fed's policy move and the broader economic outlook.
Now, let's take a closer look at the closing numbers for today, September 17th. First, the major U.S. indices. The Dow Jones Industrial Average closed at 46,018.32, a gain of 260.42 points, or 0.57%. The S&P 500 index finished at 6,600.35, down 6.41 points, or 0.10%. The Nasdaq Composite ended the day at 22,261.33, a loss of 72.63 points, or 0.33%. And the Russell 2000 index of small-cap stocks closed at 2,407.34, up 4.31 points, or 0.18%. Turning to key macroeconomic indicators, the CBOE Volatility Index, a measure of market uncertainty, fell 3.91% to 15.72. The U.S. dollar index strengthened, rising 0.41% to 97.03. The yield on the 10-year Treasury note rose 1.24% to 4.08%. In commodities, crude oil fell 0.85% to $63.97 per barrel. Gold declined 0.82% to $3,694.60 an ounce. And Bitcoin saw a loss of 1.11%, closing at $115,619.44. Now for the most actively traded securities by turnover. The top five were, first, the S&P 500 Index ETF, SPDR, which fell 0.12%. Second was Tesla, which gained 1.01%. Third, the Nasdaq 100 ETF, Invesco QQQ Trust, which was down 0.20%. Fourth was NVIDIA, which saw a decline of 2.62%. And fifth was the Russell 2000 ETF, iShares, which rose 0.26%. In summary, Today's trading session was defined by the market's skeptical reaction to the Federal Reserve's first rate cut of the year. The divergence between the Dow's advance and the Nasdaq's decline, coupled with the counterintuitive rise in long-term bond yields, paints a picture of a market grappling with fears of a stagflation-lite economy. Investors are signaling that a slightly more accommodative Fed may not be enough to offset concerns about a weakening labor market and persistent inflation. Looking ahead, the most critical variables for market participants will be the upcoming employment and inflation data reports. These figures will be the ultimate test of the Federal Reserve's new policy stance and will likely determine the market's direction in the weeks to come. If you found this analysis helpful, please hit the like button, subscribe to our channel, and share this video with your friends. The content provided on this channel is for informational and educational purposes only and does not constitute financial, investment, or legal advice. All investment decisions should be made with independent due diligence and in consultation with a qualified professional. While we strive to ensure the accuracy of the information presented, we cannot guarantee its completeness or correctness. Any risks or losses resulting from the information on this channel are solely the responsibility of the individual. The views and opinions expressed in this video are those of the speakers and do not necessarily reflect the official policy or position of this channel. This content is not an offer or solicitation to buy or sell any financial instruments.